For decades, the world's richest investors had one unbeatable advantage: information. They had private research teams, direct access to CEOs, early insights into market shifts, powerful financial models. While everyday investors reacted to headlines, billionaires positioned themselves years ahead of the curve. But what happens when artificial intelligence gains access to more data than any billionaire ever had, and processes it faster than any human mind possibly could? What happens when AI can analyze global markets in real time, simulate thousands of economic futures, and allocate capital with cold mathematical precision? We are entering an era where AI doesn't just assist investors, it invests like them. And in some cases, it may do it better. Let's first understand what separates elite investors from everyone else. It's not luck, it's not secret stock tips, it's strategy. The world's wealthiest investors succeed because they think long term, allocate capital strategically, understand macroeconomic shifts, identify asymmetric opportunities, remain unemotional during volatility, compound returns consistently. Now consider what AI is designed to do. It processes massive data sets. It detects patterns across time. It models probabilities. It operates without fear or greed. In other words, AI naturally aligns with the principles of disciplined investing. Historically, access to sophisticated investment tools was limited to hedge funds and billion-dollar institutions. Today, AI is democratizing that capability and transforming how capital is allocated worldwide. To understand how AI invests like the world's richest people, we need to break investing into four major components: information advantage, pattern recognition, risk management, capital allocation. Let's start with information. In the past, information traveled slowly. Investors relied on quarterly reports, analyst briefings, and insider networks. Now, AI systems scan global financial statements, news articles in multiple languages, social media sentiment, patent filings, supply chain movements, commodity flows, government policy updates, satellite imagery. Yes, even satellite data. For example, AI can analyze satellite images of retail parking lots to estimate store traffic before earnings reports are released. It can monitor shipping container volumes to predict supply chain strength. It can track semiconductor equipment deliveries to anticipate chip production growth. This level of real-time intelligence gives AI a massive edge. Next, pattern recognition. Elite investors identify trends early. They spot technological shifts before they become mainstream. AI excels at identifying early-stage momentum. It can detect when venture capital funding accelerates in a niche sector. Research publications cluster around a breakthrough technology. Hiring spikes in specialized roles. Consumer search trends begin rising consistently. Individually, these signals may seem minor, but when multiple signals converge, AI recognizes structural shifts. Humans often miss these because we think linearly. AI thinks in probabilities. Now let's talk about simulation. The world's top investors constantly ask, what happens if interest rates rise? What happens if energy prices spike? What happens if regulation changes? AI can run thousands of economic simulations in minutes. It stress tests portfolios against multiple global scenarios. If a portfolio collapses under certain conditions, AI adjusts exposure. This proactive risk management mirrors how sophisticated hedge funds operate. But now it can happen continuously. And then there's emotional neutrality. One of the biggest reasons retail investors underperform is psychology. Fear causes panic selling. Greed causes overbuying. News cycles trigger impulsive reactions. AI does not panic. It does not chase hype. It follows statistical models. During market crashes, while humans sell in fear, AI may recognize undervaluation opportunities. During bubbles, while humans chase momentum, AI may detect overheating signals and reduce exposure. This discipline alone can dramatically improve long-term returns. Now let's explore capital allocation. The richest investors diversify intelligently. They allocate across industries, geographies, asset classes, and risk levels. AI can optimize diversification mathematically. It calculates correlation between assets. It adjusts allocations dynamically. If two sectors become highly correlated due to macroeconomic shifts, AI reduces redundancy. If emerging markets begin outperforming under specific economic conditions, AI increases exposure. It doesn't wait for quarterly reviews, it recalibrates in real time. Another critical factor is alternative data. Traditional investing relied on financial metrics. AI expands the dataset. It considers consumer behavior trends, online purchasing patterns, app download growth, startup funding acceleration, technological adoption curves. For example, if AI detects exponential growth in electric vehicle charging installations, combined with government subsidies and battery innovation, it may increase exposure to clean energy infrastructure. Not because of hype, but because data convergence increases probability. There's also algorithmic trading. High-frequency trading firms already use AI-driven systems to execute trades in milliseconds. But modern AI goes beyond speed. It integrates macro strategy with micro execution. It identifies long-term structural trends while optimizing short-term entry and exit points. This dual-layer intelligence mimics how elite investors think, combining big-picture vision with tactical precision. Now let's discuss accessibility. In the past, only institutional investors could afford quantitative research teams. Now AI-powered investing platforms are becoming available to retail users. Portfolio optimization tools, AI-driven robo-advisors, predictive analytics dashboards. While not perfect, they narrowed the sophistication gap between everyday investors and billionaires. However, there's a catch. If everyone uses AI, does the advantage disappear? Not entirely, because AI systems are not equal. The edge will belong to those with better data, more computational power, superior models, faster feedback loops. This creates a new arms race, not of money alone, but of intelligence infrastructure. Another powerful shift is private market analysis. Traditionally, billionaires invested heavily in private companies before IPOs. AI can now evaluate startup ecosystems by analyzing funding rounds, founder backgrounds, patent activity, and market demand signals. This improves early-stage investment decisions. It reduces reliance on intuition. But AI investing isn't flawless. Models depend on historical data. Black swan events, pandemics, wars, sudden regulatory bans can disrupt predictions. AI can estimate probabilities, but it cannot eliminate uncertainty. And there's ethical complexity. If AI systems dominate markets, they could amplify volatility. Algorithmic herding behavior may create rapid price swings. Regulation must evolve to prevent systemic instability. Still, the direction is clear. AI enhances information processing. It enhances discipline. It enhances scenario modeling. It enhances allocation precision. In essence, it scales the core traits that define elite investing. The question is no longer whether AI can invest like the world's richest people. The question is whether humans can keep up, because AI operates continuously. It learns from every trade. It improves through reinforcement learning. Every mistake becomes training data. Every success refines probability models. Over time, its performance edge compounds, and compounding, as history shows, creates enormous wealth. We are witnessing the transformation of investing from art guided by intuition to science guided by data, from human-dominated capital allocation to machine-augmented intelligence systems. This does not mean humans become irrelevant. It means human investors must adapt. The winning strategy may become hybrid. Human strategic judgment combined with AI analytical power. Those who ignore AI risk falling behind. Those who understand it gain leverage. For generations, the world's richest investors relied on insight, discipline, and access to information. Today, AI brings those advantages to scale. It sees more. It calculates faster. It reacts instantly. It remains unemotional. AI can now invest with the precision of hedge funds and the discipline of legendary capital allocators. But technology alone does not guarantee success. The real edge lies in how intelligently it is used. We are entering a new era of capital allocation, an era where intelligence, artificial or human, determines financial power. And as AI continues evolving, the gap between informed investors and uninformed ones may widen dramatically. The future of investing won't belong solely to billionaires. It will belong to those who understand how to harness intelligent systems. Because in a world driven by data, the smartest capital wins. And AI is becoming very, very smart.